Your employer match might be stealing millions from your future. You've been told your 401k match is free money. It's not. While everyone celebrates that 3% employer contribution, they're missing what's actually happening behind the scenes. Your money gets locked away. Hidden fees drain it yearly. And the opportunity cost of that trapped capital could cost you millions by retirement. This isn't about rejecting the match entirely. It's about understanding the real game being played with your retirement. The wealthy know this secret. Most people don't. That's why they build wealth differently. Everyone treats the employer match like found money. Your company puts in 3%, 5%, sometimes even 7%. It feels like a gift. But gifts have conditions. That match money comes with strings attached to a plan designed to benefit your employer, not you. The company gets a tax deduction. The plan administrator gets fees from your account. Your money gets locked in a system with limited investment choices. Meanwhile, you celebrate. This is how financial traps work. They feel generous on day 1. By year 5, you realize you've been paying the cost the whole time. The match exists partly because companies want to encourage retirement savings. But it also exists because it keeps employees longer and keeps money in plans that generate revenue for administrators. When you accept the match, you're not just getting free money. You're entering a contract with invisible terms. Here's where the trap tightens. You don't own that match immediately. Vesting schedules mean your employer's contribution belongs to them until you've served enough time. 3-year vest, 4-year vest, sometimes longer. Leave before you're fully vested, and you forfeit thousands. Companies know this. They structure vesting to keep you locked in place. It's brilliant strategy on their side. You're essentially trading years of your life for the privilege of keeping money that was supposedly already yours. A technology worker at a Fortune 500 company received a $40,000 match over 4 years. He got recruited to a better position at a competitor. By leaving after year 2, he forfeited $20,000. That money went back to the company's plan, reducing their future contributions. He lost 8 years of compound growth on that capital. Vesting creates a golden handcuff. The longer you stay, the more it costs you to leave. But staying at a job you've outgrown is its own massive opportunity cost. You sacrifice career growth, higher salaries, better positions, and skill development. The math rarely works in your favor when you factor in what you give up to stay vested. Let's do the real math. You take a job that offers a 3% match. $5,000 a year goes into a 401k. You tell yourself it's free money. But that match money is locked in the plan with limited investment options. Meanwhile, the stock market is available to you. A self-directed brokerage account, real estate, a side business. The 401k plan average return over the last decade was 7.2% annually. But a diversified individual investor beat that by 2% consistently. That doesn't sound like much. Over 30 years, it compounds into millions. Take that $50,000 in match money over 10 years. In the 401k at 7.2%, you'd have $140,000. Invested externally at 9.2%, you'd have $210,000. That's $70,000 in opportunity cost from 1 decade of matches. Now extend that across a 30-year career. The gap widens exponentially. The wealthy understand this. They max out the match to capture it. Then they invest their remaining retirement savings elsewhere, where they have control and better returns. The match isn't free. It's a constrained investment forced into a plan that limits your ability to optimize. This is the insight that separates wealthy builders from average savers. Most people think millionaires max out their 401ks. They don't. High net worth investors capture the match, then stop. They redirect the rest of their retirement savings into vehicles they control. Roth IRAs, taxable brokerage accounts, real estate, business equity. Why? Because those vehicles offer flexibility, better returns, and no forced withdrawal rules. A 401k is a government-controlled savings plan. Your money must follow their rules. Withdrawal penalties before 59 and a half. Required minimum distributions at 73. Limited investment options. All of this benefits the plan administrator and the government. The wealthy value control. They'd rather own less money that they completely control than more money that someone else controls. A millionaire real estate investor we studied captured his company match of $18,000 yearly, but never contributed beyond that. Instead, he invested $200,000 annually into rental properties and business ventures. He built $10 million in net worth over 20 years. His coworker maxed out the 401k at $23,000 yearly. He had $3.2 million at retirement. Same income, different strategy. The 401k didn't make the difference. Control and diversification did. Your 401k match doesn't grow in a vacuum. It's being harvested by fees, management fees, administrative fees, fund expense ratios, investment advisor fees, some hidden in fund prospectuses, some charged directly. The average 401k costs 1.1% annually. That might sound small. It's devastating over time. On a $100,000 balance, that's $1,100 disappearing yearly. Over 30 years with compound growth, those fees consume over $100,000 of your wealth. A $60,000, $401,000 match could lose 30 to 40% of its growth to fees alone. Compare that to a self-directed brokerage account. You can invest in ultra-low-cost index funds with expense ratios of 0.03%. That's a 400% difference in cost structure. Your employer wants you in the 401k plan. They profit from it indirectly. The plan administrator profits directly from every dollar in fees. You absorb the cost. A financial analyst reviewed his 401k statement. Over 10 years, his company contributed $100,000. His ending balance was $132,000. Fees and underperformance combined had consumed $30,000 in potential growth. His 3% salary increase invested independently during that period would have grown to $190,000. The fees weren't disclosed clearly. They were hidden in layers of documentation. The wealthy have figured out a different game entirely. Capture the match. Then build wealth through vehicles they control. Real estate is their favorite. A $30,000 annual savings invested in real estate generates rental income, appreciation, and tax deductions simultaneously. The 401k generates only compound growth. Real estate generates cash flow and leverage. A business owner captures his company match of $15,000 annually. But his real wealth building happens in his business. He reinvests profits, builds systems, creates equity. Over 15 years, his business is worth $5 million. His 401k is worth $800,000. His business did the heavy lifting. Another strategy is the Roth IRA backdoor conversion. High earners can effectively save unlimited amounts in tax-advantaged accounts through backdoor conversions. This is legal, it's available, and most people don't know about it. Some wealthy individuals use self-directed IRAs to invest in real estate or private business equity within the account. This combines the tax benefits of retirement accounts with the control and returns of alternative investments. The common thread is control. Every dollar the wealthy invest, they want influence over how it's deployed. They want to understand the returns. They want to optimize the strategy. The 401k takes that control away. So they use it as a stepping stone, not a destination. Let's quantify the cost of following the standard advice. Assume a 30-year career. An average salary of $80,000. A company match of 5% or $4,000 annually. Total match over 30 years is $120,000. In a typical 401k earning 7% after fees, that grows to $1,200,000 by retirement. Now let's redirect that same $4,000 annually into a taxable brokerage account. You invest in diversified index funds with a 0.03% expense ratio. You achieve 9% annual returns. Same investment amount, better cost structure, better return. Over 30 years, that $120,000 grows to $2,400,000. The difference is $1,200,000. That's not theoretical. That's your actual wealth gap from choosing one strategy over the other. But there's more. That brokerage account is liquid. You can access it without penalties. You can reinvest it into real estate. You can take a loan against it. It's flexible wealth, not trapped wealth. The 401k creates forced constraints. Withdrawal limits, tax penalties, required distributions. The alternative creates optionality and control. Now consider that you've also redirected your own contributions beyond the match into the same alternative vehicles. The gap expands to millions. This is why wealthy people think differently about retirement accounts. They're not destination investments. They're stepping stones towards self-directed wealth building. The employer match isn't what it seems. It's a financial product designed to benefit the plan, not you. Capturing the match makes sense. Maxing out the 401k doesn't. The wealthy understand the difference. They use the match as a starting point, then build wealth through vehicles they control. Real estate, business equity, diversified brokerage accounts. They avoid being trapped by vesting schedules, limited options, and hidden fees. Your retirement doesn't have to follow the default path. The math is clear. Different choices, different outcomes. The difference between millions. If you want more videos like this, subscribe and follow Wealth Logic. See you in the next one.